Hey everyone, let's jump right into this explainer breaking down CAE's fiscal year 2026 earnings report and, well, their absolute behemoth of a multi-year transformation strategy. Look, if you track the aviation and defense training markets, you already know CAE is a heavy hitter. But right now, they're in the middle of a really fascinating pivot. We're talking a massive structural overhaul to prioritize extreme efficiency.
So here's our quick roadmap for today. First, an FY26 financial snapshot. Then, a tale of two sectors. Third, the transformation plan itself. Fourth, FY27, which is all about execution. And finally, the road to 2030. All right, part one, the FY26 financial snapshot. Let's establish the baseline. As a dominant player in flight simulators and training, CAE just went through a pretty major leadership swap. Under their new president and CEO, Matthew Bromberg, they've basically taken a magnifying glass to their entire financial posture. They're trying to figure out exactly what's actually working and, honestly, more importantly, what really needs to change. And this top-line number perfectly captures their current sheer scale. I mean, despite staring down some significant market headwinds, especially a softer civil aviation market, CAE still pulled in a massive $4.9 billion in full-year FY26 revenue. That's a solid 4% bump from last year's $4.7 billion, so right out of the gate, we know the revenue engine is definitely still roaring. But here's where things get a bit complicated. Top-line revenue went up, sure, but their annual operating income actually took a 16% hit. It dropped from $729.2 million in FY25 down to $612.3 million in FY26. What happened? Well, this squeeze was largely fueled by restructuring costs, expenses from that big executive transition, and, just general market softness. So the growth is absolutely there, but right now it's costing them a whole lot more to get it. And honestly, that profit drop really validates the new CEO's take on things. Matthew Bromberg put it pretty bluntly. The foundation is rock solid, no doubt, but the company needs a real cultural evolution. To generate better, more consistent returns for shareholders, a serious corporate metamorphosis has to happen. They just can't coast on past momentum anymore. Moving on to part two, a tale of two sectors. We're looking at the contrasting fortunes in civil and defense. To really wrap our heads around why CAE has to transform, we've got to look at this totally wild juxtaposition. On one hand, you've got the civil sector. It's dealing with a softer training market right now, which means they desperately need to optimize their physical footprint. But on the flip side, their defense and security sector is out there capturing generational growth opportunities. They're locking in new partnerships and seeing massive demand from nations trying to build up sovereign defense capabilities. It's essentially two totally different worlds right now. When you break down the full year data, the contrast is kind of glaring. The civil sector is still the absolute cash cow, right? It generated $510.5 million in profit at an 18.6% margin. But then, look at defense. It's sitting on a colossal adjusted backlog of $10.8 billion. That's essentially guaranteed future work. So even though its current operating margin is a bit lower, sitting at 9.2%, that pipeline is practically bursting at the seams. Like I said, it's really a tale of two very different engines pulling the exact same train. Okay, let's jump to part three, the transformation plan, pivoting to efficiency. So this multi-year plan, it's a very deliberate pivot away from that old growth at all costs mentality. Instead, CAE is dialing in on extreme capital discipline. The core priorities are all about aligning the portfolio with what they actually do best, laser focusing on high-return investments, and, perhaps most importantly, hardwiring a performance-driven culture of accountability straight into the company's DNA. And they aren't just talking about, abstract HR initiatives or vague cultural shifts. They are taking very aggressive physical steps. Step one is huge. They are literally ripping out 10% of their commercial full-flight simulators from the fleet. Combine that with relocating over a dozen more, massively shrinking their global real estate footprint, and putting non-core businesses under the microscope, what you get is a company radically cutting the fat and streamlining its entire operational weight. Which brings us to part four, FY27, the year of execution, or as I like to think of it, embracing the short-term pain. Because let's be real, tearing down and rebuilding a nearly $5 billion global machine mid-flight, that doesn't come cheap. CAE is projecting the total cost of this transformation to land somewhere between $200 million and $250 million. They already ate about $84 million of that in FY26, but the lion's share of the remaining bill is going to hit and hit hard during fiscal year 2027.
Because they're eating these temporary inefficiencies. I mean, literally moving massive flight simulators across the globe and pouring money into modernizing their internal tech. FY27 is strictly a heads-down, execution-only kind of year. Because of that, they're preparing the market for muted, low single-digit revenue growth and pretty constrained margins in the near term. It is the absolute textbook definition of taking short-term pain for long-term gain. Now, it's also super important to mention that internal restructuring isn't the only headache they've got right now. CAE has openly acknowledged that ongoing geopolitical volatility, specifically in the Middle East, is actively squeezing their regional operations month over month. To manage these completely external risks, they're having to defensively redeploy some of those training assets across their global network. All right, on to part 5, the road to 2030. Let's talk about unlocking shareholder value. If FY27 is all about paying the piper, this timeline maps out the massive long-term journey they're essentially selling to the market right now. Think of it like a 4-step sequence. They establish their baseline in FY26. They're taking the heavy financial hits right now in FY27 to reposition. Then, they expect a positive inflection point by FY28 when the benefits finally start kicking in, all of which leads to this accelerating, fully compounded performance by 2030. And look, a colossal part of actually making it to that 2030 promised land requires a relentless obsession with cash generation. Specifically, they're leaning heavily on an updated cash conversion rate metric. What's cool here is they've tweaked the definition to exclude non-cash paper expenses, like the amortization of acquired intangibles. Why does that matter? Because it directly links executive pay to actual cold hard cash hitting the company bank accounts. It's all about real, tangible shareholder value. And through all those painful real estate cuts and simulator relocations we talked about earlier, CAE is gunning for an eye-watering $125 million to $150 million in annual run rate savings by fiscal 2030. And here's the crucial detail. Management says over half of this entire expected performance boost will come purely from these internal initiatives, meaning it's stuff fully within their control, regardless of what the broader market does. By locking down those internal costs, they're setting up some seriously ambitious targets for 2030. We're talking mid-single-digit organic revenue growth, a cumulative 100% cash conversion rate over 4 years, and pulling their net debt leverage down to about 2.5 times. If they can actually hit those marks, it gives them an unbelievable amount of flexibility to either hunt for strategic acquisitions or just shower shareholders with excess cash, which all builds up to this one staggering absolute headline number: $950 million to $1 billion in adjusted segment operating income by 2030. Just for context, that is a monstrous leap from the $710 million they just reported for FY26. So, the stage is set. We've got the blueprint for a massive corporate evolution. They've been completely upfront about the painful costs, the cutthroat strategy, and the ultimate billion-dollar prize at the end of the tunnel. But it leaves us with one massive question, right? Will all of this short-term pain, this extremely disciplined multi-year execution, actually succeed in transforming this aviation training giant into a relentless, hyper-efficient cash-generating machine by 2030? Only time, and probably a few very turbulent quarters, will tell. Thanks for tuning into this explainer, everyone. Definitely keep CAE on your radar. This is going to be a wild transition to watch.